So actually I had two kind of quick lessons today. The first is about SPACs. You're probably seeing this all over the internet lately, and people have been asking me. So I just wanted to cover what the heck that is and whether it's appropriate for investors like us or any investors. So to start off, SPACs are special purpose acquisition companies. So that's what it stands for. And you might think of it more as a blank check company. It's not an actual company. It's a shell that's created to then go out and buy a company. So instead of doing a traditional IPO, what's great is a small company can merge or get acquired by one of these SPACs. And then that way they don't have to go out on the road. When you do an IPO, you have to be underwritten by a big company. They have to do some analysis, figure out what your starting out the gate pricing should be. And then you go on road shows and you try and sell your company or your IPO or you as an investment, right? Your company as an investment to all these different investment houses. Usually one of them underwrites you or backs you up, so to speak. And then you're going to the other ones with usually the CEO, maybe a tech, a CTO, someone high up in the company is going to go to investment houses and try and get them to buy blocks of this initial public offering. So it takes a lot of time, a lot of effort. And with COVID, the fear was that you could have a really great company, but there was so much fear in the market last year. And so much volatility that even if a company that's going to underwrite you to go public and sell your shares to your company, you might actually not get a good price just because of the environment you're in, the market we were in. So last year, these SPACs did really, really well. I mean, I think close to 200 SPACs went public last year. So it's kind of a better way to do it for a small company, only because there's limited amount of shares. Your cap is small, like the valuation or the value of your company is smaller than a big company. And really, it's fast tracking you to go public because the SPAC is usually led by an industry leader, a CEO, someone from Wall Street that's really experienced in going public with your particular industry, something like that, right? So what the SPAC does is it says, we're going to take investment money now, and then we're going to go find the company we're going to invest in or merge with. So it's almost like the reverse of an IPO. An IPO, the company's existed for a while, or maybe not that long, but it's existed for a certain amount of time, and they decide to go public. So it's kind of the reverse. You have a tangible something that's now going to get investment dollars. A SPAC is the opposite. The investment dollars come in just on the reputation, the background, who that sponsor of the SPAC is. So it's kind of almost like reverse. So SPACs typically come out to market around $10 a share. So let's just say when they do find this really crazy great company that they're going to merge with, maybe that stock price when they go public with the actual company name or product, then maybe that's going to be worth $30, $40, $50, maybe $600 a share. So that's the gamble, right? So for us as investors, we're kind of going blindly. We're giving our money first, trusting that this person's going to find a great deal to buy. Much like what we do in real estate often, people who put investors together, that's what you're doing, right? You trust this investor guy to take your $50,000 and go find a great deal. So typically the sponsor gets 20% of the shares of the company. The shareholders, once this person finds the company they're going to acquire, the shareholders can still say no. So, the downside of this is you're giving money, you're not getting a return until they find the company they merge with, right? The money's put in a trust account, so there is interest being earned, but very little. And then, what was I going to say about that? And then they have 24 months to find that company. So let's say because you're probably thinking, well, what if they never find this super duper company, especially now that there's all these SPACs out there? If they don't find the company they're going to acquire or merge with, within that 24 months, they have to close down the SPAC and disperse the money back to the investors. But for you as an investor, you've had your money dormant waiting for them to find it. Now, oftentimes they do have a company in mind. Or the better SPAC sponsors are going to have a company already in mind, and they don't want to say that because then there would be competition for a takeover. So they're usually pretty quiet about, what company it would be if they have one in mind already. So you might think, well, how many fail, right? So experts are saying this has really been growing, building steam or growing as an asset class, we'll call it, since 2016. So it's still fairly new, but the experts who are examining the fail rate of finding an acquisition or a merger, they say between 50 and 20% of the SPACs fail. So now we even have more SPACs coming to market. There supposedly right now there are 350 of them out there, and you can look this up online, of course. So who's been doing SPACs? So Richard Branson from the Virgin Group, Open Door used this as a way to go public. DraftKings, if you've heard of them, they're an online betting platform. They went public this way through a SPAC. Nikola Motor did it also. And then names of people, industry leaders who have been involved in this: Bill Gates, Bill Ackman, Tillman Fertitta, who's another billionaire guy, Richard Branson, and many more. So I thought that was kind of fun to cover today, just because it's kind of a new asset class, new way of investing, and it's really starting to pop up in news everywhere. So I just wanted to share with you what that is. So even though we're real estate investors, I'm wondering if there will be a SPAC out there to do with real estate. So I was going to research that, ask Will Pettis, who's at the California Retirement Advisors, see if he's heard of anything or could research it for us, because I think that's an interesting alternative way to invest in real estate or real estate related assets. And but there is risk, right? Your money's dormant till they find that investment. But it could be very exciting if they pick something good and your $10 turns into $50 per share. So that'll be good. So we'll keep you posted on that. And then the real estate related thing I think is very interesting. And I think, Renee's back. Okay. So we let Renee in. For realtors, I think this is very interesting. Or if you know someone who's thinking of moving for their primary residence, is thinking of changing homes, I think this was very interesting. I discovered this about 2 weeks ago and did some research and even signed up so I could get some training, see what their training is like. But this second one is what to do when you don't want to make a contingent offer. Contingent offer meaning you don't want to say that you have to sell your home to buy another home. So they call that making a non-contingent offer, when you already own a home and you're not relying on selling that home to buy your next home, right? So contingent, there's lots of contingencies, and as we all know, in buying real estate. But when you live in a home, that's one of the tricky parts, especially in this market today. There's hardly any inventory, multiple offers. So if you go in saying you're asking the seller to wait for you to sell your home to buy their home, you're probably not their best choice. They're probably not their favorite choice, and you're probably not going to win. So in this tight real estate market, making non-contingent offers it's a critical thing. So the traditional way to do a non-contingent offer is to borrow money in the form of a home equity line of credit or a swing loan or a bridge loan. There's lots of words for borrowing against your current home that you intend to sell to buy the other home, to get the down payment and the closing costs and whatever you need to get, maybe money to fix up the old home. So the traditional way is to borrow first, and then you have the cash, and then you go make your offer with 20% down or 30% down. So HELOCs are not so bad, prime plus half, or prime right around prime rate, which is 3.25% right now. Swing loans or bridge loans are expensive because they're hard money loans, basically. So they can be 8, 9, 10% interest. But that's a way to get the money you need to make the offer on the new home, right? So that's the traditional way. The trouble with that is that you have to qualify for both the old homes payments and the new homes payments, and very few people can do that. So the other option, and the kind of more conservative option, is you would put your current home up for sale, sell it, then move out or ask to rent it back from your buyer. But either way, sell that house, get the money, and then go find the new home. Well, your buyer can only let you rent back for 59 days if they got a conventional loan. You don't want to have to clean the house every time someone wants to come take a look at your home, right? You also don't want to have to make 2 payments while you're, having both homes. But if you're going to sell your home, you've got to do the open house and probably do some fix up while you're still living in it, while probably your kids are still at home doing their school, or you're at home doing your work. So it's already cramped in homes. So to have strangers come in for open house, that's even more daunting, I guess I would say. So that's kind of the traditional way of things going. Either you borrow the money and then go buy the house and have to pay the 2 payments, or you sell the home and then go buy the other home, but you either have to do it very quickly, which is hard in this market, or you have to move twice. So that's another nightmare for home buyers, is home sellers who want to be home buyers, is that, you have to move out of your home into temporary housing, wherever that is. If you have dogs, if you have stuff, then you've got storage units. And then you have to move again into your new home, right? So to avoid the double move, it would be nice if you could avoid that double move. So I discovered this a couple of weeks ago, and you may have heard of this, but I thought it was interesting. It's called KNOCK, like knocking on the door, KNOCK Home Swap. And what they do is they do both loans. They give you a loan against your current home to do the fix up, to pay the payments, to get the down payment, to go to the new home. And then they do the mortgage on the new home. So they're giving you both loans at once. And you would sell your home the traditional way. There's no change in how you're selling your home. However, if you can't sell it after 6 months, which is unlikely in this market, but let's say after 6 months, you haven't sold your home, they will buy it from you at 85% of market value. So they're kind of like your backup offer to the sale of your home, which is pretty cool. They charge a 1.25% convenience fee, which is kind of like a commission, I guess, kind of like points. I'm not too sure how they get around the words, how they get around compliance around all that, but 1.25% convenience fee on the price of the home you're selling, and that's basically like charging interest. So if you pay them, let's say you sell your home within 3 months, they've made 1.25 times 4, basically, right? So it's not bad for them as a fee. And then they said that their rates on the purchase are competitive. So whatever that means, the interest rates are competitive. You cannot separate them, so you can't get the swing loan. We'll call it the swing loan. So it takes 1.25 points to do their fee. And then if you don't sell within 6 months, they will buy the property from you. So that's good. And it's basically the most important part of this is the non-contingent offer. Oh, that's where I was. So you can't separate the loans. So the old property, they won't give you the swing loan without doing the purchase money loan. So I guess that's where they're really making their money. But obviously I haven't seen their books. So I was going to try and pencil out to say, okay, what is it really worth? Because they're saying they're charging competitive rates. But I imagine the interest rate on the purchase loan is probably 0.25% higher because they're doing all this. But that would be good to do a dummy file and just have someone go through the steps. Now, one thing for us in California is tricky because the maximum list price is $850, and across the nation, the maximum list price is $750. So it's a little bit limiting for us, but I'm thinking, maybe Lawndale. I don't know if Lomita is still that low, but if you have someone who needs to sell their condo before buying a single family home, this would work. They say that you should have about 30% equity for the numbers to work, but I would think the higher the price, the more those numbers work because you're covering closing costs and mortgage payments. Well, the higher the amount that your house is worth, or the numbers get easier. So They gave examples of 5% down. They gave examples of 10% down. So how this works is obviously as a lender, I wouldn't be doing this because they're a lender. So as a realtor, you would sign up as a KNOCK certified realtor and then just have your client apply online. So I think it would be good to have someone go through the steps and just see how the numbers work. But anyway, I thought that would be interesting to share with you because right now, if you're a home buyer, making a contingent offer is difficult for everybody. So keep that in mind. And I know Brooke is a realtor. I don't think anybody else is. I have a real estate brokerage license since 1994. So I signed up as a KNOCK certified realtor just to go through the steps and get the training. And it's very simple. So Brooke, you might want to put that in your toolbox as well.
What's it called?
It's called KNOCK, like knocking on the door, KNOCK.
Okay.
And I signed up as a realtor for cities I knew probably would never work. Like I signed up for Torrance and PV or whatever, just to get in their system. But really, because you'll get the leads, you know, if someone goes online and someone goes online and like applies or puts their house's parameters to see if they qualify, you would they refer those leads to their KNOCK certified realtors. So it could be, you know, another source of business for you.
Okay. Cool.
Yeah, it seems pretty cool. It obviously has limitations, but also after I did my SPAC notes, I thought, well, KNOCK is a perfect example of one of those companies that one of these SPACs might go after to buy, right?
Yeah.
A lot of tech, a lot of real estate tech, fintech type of companies are hot targets for these new IPOs. So I wouldn't be surprised if they turned out to be a SPAC. I heard also that WeWork, the one that was going to go public in 2019 and had issues with their business model, but also with their CEO had some issues. So I heard they were going to get acquired by a SPAC too. So it'll be interesting to watch all of that as this year unfolds and changes from 2020. So, okay, so those are the two lessons for today.